Hello, my fellow investors. It is I, Lucas,
And me, Marcus.
here again with the Financial Podcast. And in today's episode, we're discussing. Tell me,
The
Marcus.
basic rules of investment. How to prevent self-sabotage when investing.
Yeah. So, maybe if you want to get us started.
Yeah, I think like the first thing we really have to talk about is like your risk tolerance. What are you prepared to potentially lose? How does this work with how much you want to gain? Which platforms are you ready to use? How confident are you with different sites handling your money, your hard-earned money?
Mhm.
You know, things like this. You really need to figure out what kind of investor you are, how risk aversive or tolerant you are, because if you're really risk aversive, you want to take no risk, then you should probably watch the video we made before this that we touched a lot about, like index funds and mutual funds and stuff like this. These kinds of investments are generally less risky, so they might be the right choice for you.
Yeah, and if I may just say
sure,
something
go
real
ahead.
quickly about that, and even funds are considered more risky compared to other things such as bonds.
Yeah,
So we'll
yeah.
definitely, I think, make a separate podcast about that in the future, where we only discuss, for example, super low risk risk investment options that you have.
Yeah, and maybe the different
But-
kinds. We haven't really talked about bonds and obligations and ETFs and things
Yeah.
like this.
But so more on that in the future. But yeah, as you said, index funds is a good place to start. But there's some risks involved with that
sure.
as well.
All kinds of funds. There are risks involved, but they are not
Yeah.
as risky as, for instance, stocks. Yeah,
Stocks.
stocks are probably one of the more risky options you got. And then
Yeah.
peer-to-peer lending, I would deem it very risky also, because there's a lot of things to go wrong. The potential earnings are high, but you also have to be aware that the risks are very high and that you might indeed lose a lot of your money. So you have to think of it like, are you the investor that kind of just want to set it and forget it? Or are you more like the gambler almost, that you are prepared to have like a 50% chance of winning a lot of money or a 50% chance of losing a lot of money? These are things that you should definitely consider before starting investing, and things to just have clear in your mind what kind of investor you are when you start.
Yeah, two things about that.
Yeah.
I think asymmetrical risk is definitely something as well we'll cover in more detail in the future, but just a quick remark on that. When we talk about asymmetrical risk, you usually want to research enough so you know that the potential for something, if you invest in something, it has the potential to earn you a set amount, and it has a potential to lose you a set amount. And you usually want those ratios to be disproportional in your favor, meaning that what you tend to want to go for is a 3-to-1 reward versus risk, or 5-to-1 rewards versus risk, so that you always, when you risk something, you stand to gain 3 times or 5 times that. How you do that exactly and the different means you can do that, we can't really discuss here because it's
a big topic.
It's quite complicated, and I don't even really know exactly
works,
myself right now what would be a good example right on the top of my head. But also just when you manage your risk in terms of how likely are things to happen, how likely are you to make 20% compared to lose 20%, then you could look historically and said that, well, historically this has happened 3 out of 4 times, and look at things like that as well.
Yeah.
So that's just something I wanted to throw in there real
I
quick.
could just like take the most extreme situation, and this is insider trading, which you might be familiar with. Insider trading is when you have some context, like in the company board, for instance, and they tell you, yeah, we're gonna launch this update, or we're gonna do this and this, and the public doesn't know, but I'm telling you, so you can buy as much stocks as you can for the current price of our share, and then when this thing releases, then you will make a lot of money because nobody else knew it was coming, but you knew that this is gonna happen. I can just quietly sit here and accrue as many of these shares as I can, and then when they finally reveal this to the public, to all other investors, I already have a very good position since I bought it at a very cheap price, and now it has a much higher value than when I initially purchased it.
Yeah, so that would be a good extreme example
but
of.
that's illegal.
Good,
that's
good
also a risk
illegal
assessment,
extreme
like,
example.
That's also a risk assessment. Like, is it worth it?
Yeah.
Because you can definitely make a lot of money on it. But yeah, don't do insider trading though. It's illegal.
But getting back on topic, so risk tolerance, know what you're willing to risk, and don't do things that you know you can't stomach. Because usually we tend to think of ourselves as much more risk tolerant than we really are. It's easy to say that, well, I have 60% of everything I own in stocks or in whatever investment you have. Real estate, take the housing bubble for example, and it's really easy to ride that wave while everything is going great when you're up 20%, but then suddenly when you're down 30% overnight,
it's
like similar to what happened here in the beginning of Corona crisis and what might happen again, it's harder to stay your course. So I think that kind of moves us into the next point, that remember that you're in investment, generally speaking at least, especially with index funds and things we've talked about previously, you're in it for the long run. You don't want to get in when it's good and panic and then get out when it's bad, because then you're going to lose money.
Yeah, I saw an incredibly good video about this actually, that they had a very good, I think it was maybe Warren Buffett's investment strategy or someone else's, but it was a famous investor, and he had like a tracking system of 3 weeks or something like this, that he looked at the stock, then he checked it 3 weeks again, and if it had risen by a certain percent, he would buy it. Then he would check again in 3 weeks, if it had risen, then he will buy it. And then he did this, until it was at the top. So he didn't know when it's gonna go down, but then if he saw like, okay, it has lost value now after 3 weeks, now I'm gonna sell. Then if it loses even more, he might sell even more. I guess that at some point when it started losing value, he tried to sell basically everything, but I don't think he sold everything the first 3 weeks after the prices started going down. And in these cases, obviously, the share is going down at a slow pace. Because if it's crashing, then you might want to have a different strategy. But I think that his purchasing strategy was really good. That you should check a stock every 3 weeks, see how the price develops, make your purchases based on this.
Yeah, and there's a lot of strategies that we'll go into more. For myself, I know just in general that at the level I am right now when we're recording this, it's very much a beginner at this, and I know both of us are. Remember that this is a journey that you get to come along on, that we're by no means, we do not claim to be experts. We're telling you what we found out and what we think we know, but take it with a grain of salt.
So you could go over to like point 3, which we have briefly touched on, that you should stay your course.
So this has to do with stay in it for the long run, is you should commit and stay your course. So you probably want to have some idea of where you want to go, and then you want to commit to it, and you want to keep on doing that you have some sort of basic plan.
And I think this could though be applicable even like on short-term investments. If you are committed on selling your shares at a certain point, maybe it's a good idea to sell them even though there might be chance of them rising, because if this is the risk level you're comfortable with, I'm comfortable with the earnings I get from this price level, then maybe you want to sell them. Depends on your situation, of course, but if you need the money, for instance, just sell them and be happy with, you got fairly decent earnings. Probably should be happy with that and don't think about maybe it rose a lot afterwards.
Yeah. So now we talk about knowing your investment. Maybe I'd say that this is especially true for stocks.
Yeah.
So since Marcus, you're more
of a stock guy.
You've done more with stocks than me so far. So do you want to elaborate on this, knowing your investment?
Okay, this is also a thing like Warren Buffett very much stresses, is that you should really know what you're getting into. You shouldn't go into markets even that you don't know, because he stressed, for instance, he didn't go much into the computer industry early because he didn't know anything about it. He didn't know how it worked. I think he particularly had a problem with how the software companies are valued. That could they actually accrue this amount of capital that they are currently priced at, because they are priced to astronomical levels, and to gather this kind of funds would be nigh on impossible, because there almost isn't that much money in the world to get it all. So he didn't like this thing, and I respect that. I think it was a good decision by him to not go into this market, although it has been incredibly profitable, because he didn't know anything about it, was not comfortable with how things worked, he didn't understand it. It might do now, I can't speak, this might have been an old video, but I think that is generally good advice. I mean, you should know how the economics of the market you are getting into works. For instance, or company. For instance, if you think a company might be doing good, but they have terrible debt, they have a lot of debt, then it might not be a good idea to get into this company anyway, even though it's going good now, because it might crash when things go bad. because it has so much debt that it cannot repay. So the interest rates is gonna kill this company immediately when it hits like some kind of hurdle. So that's the thing you really should know, is how is like the economics of the company working. You don't have to know what kind of products they make, how are they used. It's a good thing to know these kinds of things, but it's like an add-on. The more important thing is like, how are they financed, how is the economy around this company working. And if you go hardcore, you can, I sometimes do this, is you actually go through the annual report and you check what kind of debt they have, what kind of different positions that have, how much inventory do they have, things like this. But that's for another video. It's a little bit more complicated. But generally what you want to know is some things about your investments, like if they have a lot of debt. I think that's probably one of the most important thing, because a company might even boost its value through debt on the short term. So you want to know this. It's really hard to know if a company is going to be a star and okay, it's doing poorly now, but it's going to grow immensely. If you know these kind of things, obviously invest, but I think most people can't do that. So what I would look for is mainly debt and maybe historical data, so that you have an idea of what you're getting into, so to speak.
Yeah, and I think that story you told about Warren Buffett just holds a really good overall lesson in general, which is that you shouldn't try to do too much either, because it might be really tempting if you are new to this, if you're anything like me, that you really want to get your toes wet and just try everything. Which of course is good, but then you should really limit how much you spend in the beginning, because you won't be able to make the right call. If you do go into stocks and you buy things and you manage to sell them all for profit, you were lucky that day. Like that's the end of that. You didn't predict anything. You're not special. Trust me, you're gonna lose that money again unless you get really good at what you're doing. So therefore, especially if you want to invest, like Marcus talked about, all of that what he talked about takes a lot of time, and so you can't try to do like
research
10 different things at once in the beginning. You should start with one, read up on that, then move on. And that's just a really good attitude to have overall in life, I think, as well. This is something I struggle with a lot. Like, I always get so excited and try to do everything at once, and then I just don't do anything either to completion or where I don't do a very good job at it.
You might be overwhelmed. I think that is a good point. To draw on my personal experience, for instance, I have never invested into a company that I haven't first checked out. I've actually looked through the annual report of most of the companies that checked out. And I think that's a general rule of thumb. Never invest into a company that you haven't even Google searched. Like that's a really good rule, because you can find a lot of data about this company. You can even use sites that investors rate these companies, and they talk, what do you think about this? You can check their opinions. I'd say begin there, see what other investors have to say. Do they think this is a good investment? Because if they don't, then you shouldn't probably invest either. And Lucas said, I'd say in the beginning, specialize, because you really want to know like one market, and you know it fairly well, then that you know basically nothing in 10 markets.
And this is if you're trying to invest, which again is super difficult. Like, especially if you're taking the stock approach that Marcus is doing. Day trading is slightly different, and swing trading also, so that we can't really discuss here. To me, day and swing trading isn't so much investing as it is just trying to make money as a career, because you're not really, it's not passive by any
stretch of the imagination. It's really like
not by any stretch of the imagination, exactly. So I don't know how much that applies.
I think we shouldn't talk basically anything about day trading. This is not applicable. If you're into that, then listen to something else.
I won't rule it out, because I've been really excited to get into that, so we'll see how that turns out, but right now I don't really have the time.
That might be further down the journey in that case.
The financial podcast journey. Well, let's take a quick recap of today's episode of the financial podcast. So we've discussed some of the basic rules so that you don't self-sabotage when you get started with investing. First of all, know your risk tolerance. Don't get in over your head. Don't invest more than you can bear to lose. Research your fiduciaries.
Basically, I'd say research everything. Never do anything.
All of it.
Don't
write an essay about it.
Don't make
Give it to your teacher. Get some extra study points.
Putting in what you're gonna do into the Google search bar. Don't do anything.
Yeah.
You know?
Okay, but again, so know your risk tolerance, stay in it for the long run. Relating to that, commit to your investment and stay your course. Even if times get bad, don't get off that horse until times get better. Generally speaking, sometimes you have to cut your losses, of course, I understand that.
Or if you need the money, you have to sell even though it's rising.
Yeah, but generally commit to your course. Then know your investment, know what you're doing, Google everything,
Google
research everything. Research who you're buying from, basically the middleman, the middle
always research
site.
Because people forget about the middleman and what laws are applicable, and that's a topic for a totally different video. The legal stuff in regards to everything, because there are things you have to think about, but that's a whole different kind of worms. But when it comes to legal stuff, check what applies in your country and maybe actually get a financial advisor to talk to you about these issues.
Yeah, you should
because
do
we
that
can,
if we're talking any big sums at all.
And legal stuff in general, because none of us study law or anything. I've studied some financial law, but it was not applicable to this. So those matters, speak with someone that you can actually count on.
Yeah, but for now, I would like to thank you for listening to today's episode of the Financial Podcast. These are just general good advice, I'd say.
Yeah, when getting into investing. So if you are already heavily invested, so to speak, maybe this is not...
Yeah, you know this stuff already, then it's
for
really
beginning.
old. But if you found anything of this useful, please leave a like and maybe subscribe, because there's going to be a lot more where this came from.
Yeah, and we kind of need the support right now. It'd be nice.
Yeah, we're small.
Yeah, and please leave a comment also, because in these videos we are gonna mess up sometimes. We're gonna forget things. We're really gonna appreciate it if you could post your comments. Like
all
thoughts,
feedback is appreciated.
Maybe you have some topics you want us
afraid.
to talk about. Please leave everything.
Yeah.
Anything counts.
Yeah. Okay. Enough. Enough of the begging now,
exactly.
and we'll see you on the next one. Thank you, guys.
You.